Welcome to our video seminar. I'm John Heinlein, CEO and Senior Portfolio Manager at Horan Capital Management. This presentation falls into two categories, the first being the upcoming presidential election and its impact on the market, and the second being how our investment philosophy helps us navigate this uncertainty. The topic for this content is based on what we think is important after talking and meeting with many of our clients. You will see in this video how the media thrives on sensationalism and how it makes investors do the wrong things at the wrong time. As your advisor, we take the emotion out of it and stay focused on your long-term goals. We hope by the end of this presentation you will better understand our approach to investing, not just during turbulent times like the election season, but every day, no matter what the circumstances. So, without further ado, let's jump into the topic for the day. How could the 2016 elections affect your investments? Here are a few disclosures I'd like to bring to your attention so I can keep the regulators and attorneys happy. Every 4 years, investors have to grapple with the volatility and uncertainty that come with a presidential election. Sure bets drop out, and long-shot candidates surge to the front. Every election comes with plenty of surprises and uncertainty, and the 2016 election is no different. As financial professionals, we field a lot of questions from our clients and friends about how politics and elections affect financial markets. We created this presentation to answer some of these common questions and concerns. Here's what we're going to talk about today. How do investors feel about the 2016 election? What does history teach us about elections and markets? Does it matter who wins? How do we manage portfolios during uncertainty? Let's start by discussing some of the common concerns investors may have about the election this year. Gallup, the research company, polls Americans on a variety of issues every month. This chart shows what Americans think is the biggest problem facing the country today. As you can see, recently there has been a big spike up in race relations, but aside from that, the economy and dissatisfaction with the U.S. government have consistently been the two most important issues to Americans over the first half of the year. You also notice that the other issues listed, immigration, unemployment, and elections, to name a few, have been fairly steady throughout this time period and frankly not viewed with as much importance to most Americans. With that said, if this poll were updated through today, I suspect elections would have a bit of a spike up as well. Many people ask, how do these problems affect the markets? Another good question would be, do these problems impact the way that we should invest? Hartford Funds surveyed a group of affluent investors about the 2016 election and found that the vast majority worry the election will cause volatility in financial markets. These fears are perfectly natural. Markets hate uncertainty, and the presidential election thus far has been a roller coaster. Now, let's take a look and see whether these fears are founded. Though the past doesn't predict the future, we might learn some lessons by looking back and seeing how markets have behaved around elections in the past. Despite some volatility, election years have historically been positive for stock markets. This chart shows annual S&P 500 performances since 1960. We can see election years highlighted in green and red. In 12 of those 14 presidential election years, the S&P 500 has ended the year positive. In just 2 of those years, 2000 and 2008, stocks have ended negative. Most of you probably remember those years. In 2000, stock markets faced the dot-com crash. In 2008, we had the financial crisis and the beginning of a recession. Neither of those precipitating factors had anything to do with a presidential election. So, does it matter who wins? This is probably the question that you've been most eager to hear the answer to. Before I answer it, let's take a look at history. Does the market do better with a Democrat in the White House or a Republican? Here's what a national poll of investors found. Most Americans believe a Republican president will be better for their investments. Has that been historically true? Let's find out. The numbers show us that S&P returns have actually been higher during a Democratic presidency. On average, the S&P 500 returned 8.71% each year under a Republican president and 13.29% under a Democratic president. Are you surprised at this result? It's a little counterintuitive, isn't it? Many Americans see the Republican Party as a more pro-business and therefore more likely to boost the stock market when in the White House. However, that's not historically the case. Our view is that we cannot draw distinctive conclusions from these averages. We believe that there are too many factors that are involved in determining the market's return to know the exact cause. Let's take a look at individual presidencies and see what that shows. This slide shows us how the S&P 500 fared under each presidential term since 1961, starting with JFK's presidency. Now, the previous slide showed that the S&P 500 has done better under Democratic presidents. But you can see here that there's more to the story. The best performance was under President Gerald Ford, a Republican. However, the worst performance happened on George W. Bush's watch, another Republican president. Presidents don't operate in a vacuum. The policies of their predecessors, economic realities, political realities, and many other factors influence what they do. While this chart is interesting, we believe there is really no predictive value in looking at the president's party affiliation in determining potential stock market returns. Even if we could see a pattern between stock market returns and the political party of a president, it would not affect how we invest. Like Warren Buffett, we are looking to purchase good businesses at attractive prices and letting them compound over long periods of time. The values of businesses are not affected by whomever is in the White House. Does who is in the White House affect markets at all? Sure, indirectly. However, the release of a new iPhone by Apple may have a greater effect on the overall S&P 500 performance than the president. Why? Apple is the largest company in the S&P 500 by market capitalization, and the iPhone is its most important product. Back in 2014, Apple and sales of the iPhone drove 18% of the S&P 500's performance that year. Products, innovation, and other factors have a much more powerful effect on market movements. Now, I want to point out that though presidents might not directly control markets, they do hold a lot of power in terms of legislation, politics, and getting things done in Washington. Each candidate has a platform, and the decisions that the president makes in office could have a big impact on your financial bottom line. However, there's a big difference between what a presidential candidate says during the election and what actually makes it through the legislative process. We always emphasize that markets hate uncertainty, and the election this year might very well cause some volatility. Depending on which party ends up controlling the White House and Congress, a lot could happen or not happen, legislatively, that could affect certain sectors and markets overall. So we talked about some worries you may have. We've talked about history of the markets and elections. Now, let's talk about what we can do about market volatility. The most important thing we can do is ignore media headlines. Here are a few headlines we pulled from the last 6 months. Trump and Cruz predict stock market crash. GOP donor Paul Singer says Trump would cause a depression. Should investors fear President Trump or Clinton? The end is coming, says Ron Paul. 80% stock market crash to strike in 2016, economist warns. How can you keep your cool when you read that in the morning paper? There are always going to be headlines telling you to panic. News outlets need headlines to pull in viewers. One of the ways they do that is by turning minor events into breaking news panics. This chart shows S&P 500 price performance between 2004 and 2014 and CNBC viewership over the same period. Do you see a correlation? Notice how viewership spiked as the stock market fell during the financial crisis. It wasn't because they were telling everyone to keep calm and carry on. People tend to focus on negative information and turn to the media in times of crisis. That's not a great way to keep your cool. Don't listen to the talking heads. Tune out the noise. Our investment philosophy. We view stocks as businesses. We are bottoms-up investors. We focus on individual companies and do not attempt to guess the direction of the economy. We are patient long-term investors. We view risk as permanent loss of capital, not price volatility. We view stocks as businesses. Here's a quote by Warren Buffett. If you're an investor, you're looking at what the asset, in our case businesses, will do. If you're a speculator, you're primarily forecasting on what the price will do independent of the business. The foundation of our approach is investing in companies that are priced by the market at a significant discount to their business value. We think about investing as the purchasing of companies rather than the trading of stocks. What matters in the long run is a company's underlying business performance and not the investing public's fickle opinion about its prospects in the short run. We are bottoms-up investors. We focus on individual companies and do not attempt to guess the direction of the economy. Here's a quote by Ben Graham, Warren Buffett's mentor. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. John Templeton. I'd never ask if the market is going up or down because I don't know, and besides, it doesn't matter. I search nation after nation for stocks, asking, where is the one that is the lowest priced in relation to what I believe it's worth? The essence of value investing is to know the company's intrinsic worth because the market will sooner or later recognize this. Markets are risky. Good businesses are not. Here is a quote taken from an excerpt from a Warren Buffett letter to the New York Times during the height of the financial crisis. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So, if you wait for the robins, spring will be over. We recognize that the market's reaction to short-term events can produce large swings in a stock price that are unrelated to the long-term prospects of the company. We look for such swings when they produce an attractive entry for a good business. We view risk as permanent loss of capital, not price volatility. Price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when the prices fall sharply and to sell wisely when they advance a great deal. At other times, he will do better if he forgets about the stock market and pays attention to the operating results of the companies. Peter Lynch said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. We at Horan look at volatility as an opportunity and not a risk as we attempt to price and not time our investment decisions. Another important tactic for long-term investors is not to let emotions take over. This chart shows the hypothetical growth of a $100,000 investment between 1996 and the end of 2015. It also shows many of the emotions an investor might feel along the way. It includes euphoria when markets are high and surprise, nervousness, panic, and defeat when markets pull back. It's all normal and all part of being an equity investor. The investor who remained invested in this hypothetical illustration might have seen that investment grow to nearly $500,000. Investors who sold out during the lows would have missed out on the rallies that followed. Keep in mind that this is just a hypothetical illustration that doesn't include factors such as taxes and fees. It's not meant to show the performance of any actual investment. To wrap up everything we've discussed today, most Americans expect the elections to continue to produce market volatility, and we don't disagree. We view volatility as opportunistic moments in which we can add value. We flip the role of volatility as a measure of risk to a source of opportunity, and view human emotions and irrationality as the real source of risk as losses are realized without merit. As an example, permanent loss of capital. There are more important factors than the presidential election that drive the markets. Regardless of the election outcomes, we will seek to benefit from the irrational behavior of the market. We believe that fundamental or company-specific events drive stock prices in the long run. We take advantage of short-term market inefficiency by buying stocks in companies which we believe are being unfairly impacted by short-term factors. Stay focused on your long-term financial goals and ignore the noise. Our main task of bottoms-up investment management of our clients' investments is how we sift through the market noise to calculate the intrinsic values of the companies we own or are interested in. Our investment philosophy strips emotions from the equation and strictly utilizes company fundamentals and the disparity between market price and intrinsic value for individual stocks as a guide to investing. This concludes today's presentation. We hope that you enjoyed the information we shared, and if you have any further questions or want more information, please contact us at this number or come visit us at our website.